So for more, let's bring in Barry Knapp. He's Director of Research at Ironsides Macroeconomics. Barry, I'd love to get your read on the CPI number. Of course, one of the few data prints that we've been able to get, albeit, delayed, and I guess sounds like the government had to pull some extra strings to get it to us. But 3% initially, earlier on the show, we had Krishna Guha saying that's pretty benign, at least from a market perspective.
The two issues that I haven't heard discussed over all the commentary, and I've been listening all morning. I saw you on Squawk Box earlier. There's two very important concepts that have been missed generally. One is the role of government spending in the inflationary process. Go all the way back to 21. We know that was the spark that lit the flame in March of 2021. Goods prices went from slightly negative to plus 12.5% within a year after $1.9 trillion in stimulus, and the government sent everyone roughly $500 billion of checks. If you think about where super core services inflation was a year ago, it was at 5%. Mm-hmm. Government spending in the fiscal year ended September of 24 went up 11%, effectively the last year of the Biden presidency. In the fiscal year ended 2025, this September, government spending has cooled to 3%, and that super core services inflation is all the way back to 3%. So there's lots of idiosyncratic issues within that measure, but nonetheless, that is the sector you'd expect to be most influenced by fiscal spending. So that's a very important point, and that's what the Fed, it's really the Fed's blind spot in thinking about inflation, is the role of fiscal policy. The second issue is, as I was listening to you discuss it with Krishna, staples sector margins are at their lowest level since the GIC sector was introduced. They're under a lot of pressure as a consequence of tariffs. They have seen weakening demand and pressure on profit margins. You're also seeing pressure on profit margins in the consumer discretionary sector. So with fiscal policy tightening, monetary policy very tight for floating rate small business borrowers, there's no ability to pass prices through. So yes, the headline number is at 3. It's above the Fed's target. We've only been below the Fed's target 1 decade of the last 3. It's kind of a ill-advised target. But that notwithstanding, all the conditions that were in place to create inflation in 21 are not in place today, and inflation is likely to head lower in the months to follow. And I didn't even mention housing inflation. Of course, we know that's still overstated. It's at 3.5. Alternate measures are more like 1.5 or 2. I think Blackstone mentioned yesterday their internal measure is more like 1.8. So inflation is really not an issue from this point, and the Fed should be far more focused on the labor market.
Those are all very, very interesting points. Another comment that came up yesterday was the discussion, since you were talking about services after you were talking about the government spend, is that folks are less likely right now to buy a cup of coffee. If they're not going to buy a cup of coffee, they're certainly not going to buy a car. I mean, what do you make of the aggregate pressure on the consumer from the current rates of inflation that we've seen so far, at least, even if, maybe 3% doesn't feel too bad to you when you're looking at relative history?
Well, the biggest issue for me is the way the Fed tightened policy. Kelly and I, have been talking about this for years now. But because they eased primarily through their balance sheet and tightened primarily using rate policy, that put the burden of tightening on floating rate borrowers. Those are households without assets, so those living paycheck to paycheck. But it's also small businesses, small banks. And the good news is 100 basis points of rate cuts in total, including the 25 they've already done, will boost small bank profitability to the point where that credit channel will start to ease. Financing costs for small businesses will come down. So there is some relief in sight. It's overdue. The Fed should have gone 50. They should have started in July. But if they do cut by 100 basis points, a lot of that pressure will start to ease. And then, of course, we know beginning in February, the individual provisions of the what did I hear Joe Lavorgna call it yesterday? OBBB will start to kick in from tax refunds. And so some of that pressure could start to ease early in 2026. But for now, the Fed can't really take that risk because we know we've been overestimating small business employment by some 79,000 jobs per month in the year ended March. And that likely got bigger, that overestimation, since March after Liberation Day, because we know demand for labor has weakened considerably. So the Fed really does need to be cushioning the slowdown in government spending, the impact of tariffs, which the market told us clearly were a much bigger risk to growth than they ever were to inflation. Fed didn't seem to get the memo on that, but the market surely did. And it's really time for them to just keep going and start easing that pressure.